Good afternoon, everyone, and thank you for joining us for another one of Avant-Garde Trading's free educational trading webinars. We are happy to have you all here this afternoon, ready to learn about option Greeks. We have Vlad Karpel with us this afternoon, and we also have Keith Harwood stopping in as well to provide some extra commentary. Thank you both for being here today. Are you with us, Vlad and Keith?
Yes. How are you? Thank you for having us.
Yeah, thank you again.
Thank you for being here. Appreciate it. Yeah, thanks for coming, and thanks to those who are joining us live this afternoon for a little lunchtime options trading. Vlad, if you are ready, you can go ahead and share your screen and begin your presentation. As a reminder, for those of us live, if you have questions during the presentation, please type those questions into the chat box or the Q&A, and I can get those over to Vlad or Keith to address at the end of the presentation. All right, Vlad, I can see you, and I can see a trading screen, now your presentation. So feel free to begin when you're ready.
Sounds good. Again, thank you, Natalie. Thank you, AGT, for having me and the opportunity to present. This is Keith's favorite topic and mine, options Greeks. So if calculus was your favorite subject, then you're going to have a lot of fun. If it was not your favorite subject, we're going to try to make it kind of, at least from my perspective, things that can make a difference, right? If you trade in options, or even if you don't trade in options, even if you trade stocks, some of the consideration that can help you, optimize your entry, optimize your exit prices, and help you with the allocations. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first. Always want to welcome new subscribers, new participants. So type in hello to let us know if you know about option Greeks, or if you trade options, or if you trade stocks, how many years. It will give me a little bit context of how much time I want to spend. We want to spend on some of the more advanced topics versus the easier topics. My bio: I was Executive Vice President, Head of Technology at Options Express. Worked for several broker dealers in my past. Worked for hedge funds. I started Tradespoon and Yellow Tunnel. Been doing that for many years, and managing my own money and sharing experience with my subscribers trading. So my background is quant, analytics, artificial intelligence, and building models to find signals in the market. And then Keith joined probably over close to a year and a half ago, and we work together, and he brings a lot of knowledge in options Greeks and calculus and statistics and market making. Keith, you want to give maybe?
Yeah, I think that's a good summary. I mean, so I was a market maker on the CBOE floor, started that back 20 years ago. So I've got a background, of course, in the options, analytics, and the Greeks and everything. One of my favorite topics, as you mentioned. Also worked with for a commodities-based hedge fund, designing a lot of their option strategies and working to optimize options given a directional bias. So, the work together that Vlad and I are doing is, I think, really great, and I'm looking forward to hearing a little bit more about where Vlad's perspective is on some of the Greeks today.
Perfect, thank you. I'm gonna go through some trade setups and trade ideas, just general. So disclosures, I think, is important. You already saw AGT disclosures. This is just general disclosure in terms of if you're new to options, and you want to know, and if you're new to trading stock and options, or this is the first time you see the slide, I do encourage you to visit optionscreener.com so you can understand the risk associated and suitability associated with trading stock or options. You can always pause the screen or take a screenshot and read the remaining of the disclosures. All right, so first is, we covered puts and calls, right? For those of you, did anyone say if they trade options or not? Because if nobody had traded options, then, that would be, John, welcome. Thank you for joining. Dr. Simon, I see familiar names. Perfect. Trader. So a lot of you traded options, a lot of you. Familiar names. Thank you for joining. I appreciated it. So again, just quick summary: calls, you're bullish and you want to leverage your account. You want to buy a contract that gives you a right to buy a stock. And then puts, if you want to hedge your stock portfolio, or you want to hedge a stock, you can buy a certain strike price, certain level. It gives you ability to hedge in case there's a correction in the market. So I don't know if you, but usually there's a market maker, right? What Keith used to do, he would run certain models, some on proprietary model, some on Black-Scholes model, that basically you can feed information like interest rates, dividends, and that the Black-Scholes model will give you what is the theoretical value of that options, right? And then the market makers would have to, provide these options. And this is how options are determined. So you have sensitivity is a strike price, right? Which level are you trading? If it's spiders, and right now we're, retesting 6,900, on its way to 7,000, then it would be SPX 6,900 or 6,800. We had a short pullback today. Time, it's sensitive to time remaining until expiration. We're going to talk about these sensitivities. Price of underlying stock, volatility of underlying stock. The higher the volatility, the higher premium you have to pay, right? When we go into the earnings, you would estimate, or you would guess that the option price for contract is much higher. And then after the earnings, once the uncertainty is gone, then the option price drops. Interest rates don't change that much. Dividends don't change that much, so they don't have as much impact on the theoretical value. So that's one unknown. There are a lot of broker dealers. You can enter this information, and they'll give you theoretical value. They run Black-Scholes model in the background. Because you want to estimate what is the option if price of the option, the volatility jumps right after the earnings season or after the second phase of Liberation Day, or something like that. So you could use these calculators to estimate the price, right? So, probability calculator. The next one is options delta. Delta is important because it shows you basically, I think of delta as velocity, right? The change of price, how quickly the price change, right? Was the, not versus time, but versus $1 move in underlying stock, right? So positive data, position generally gains value, right? Negative delta, stock is down, position generally loses value, right? And delta is important, especially if you want to determine what your overall view on your portfolio, right? A lot of broker dealers, you can go in and it'll tell you what is your portfolio delta across all of your positions. And if you think the market is overbought and, Meta didn't have great earnings. I mean, they all had good earnings, but you can see that market reaction is being muted, right? Meta is down, I think. Amazon was down last time I checked. I mean, Google did well, so you can say, okay, maybe I'm going to be market neutral, right? And you can look at your overall portfolio delta, and we'll see how many of your positions will go higher if market goes up, and how many of your positions will go lower if the market goes down. So that's delta. I usually think about delta as just a velocity, right? How quickly will my position move for one move in underlying stock, right? So delta is usually 0 to -1, and it's, you can think of it as a hedge ratio, right? Delta 50. If you have a stock position, it's delta 50, then this can give you a sense of, how many contracts do you need to buy to hedge your stock position. So delta is important, right? Usually at the money delta is delta 50, so you know for 100 shares, you need to buy 2 contracts. So traders often use delta as stock equivalency for that option. Delta tells the trader how many shares of stock to buy or sell to establish the offsetting position to create an overall delta, neutral position. I go into portfolio delta. Long stock, basically by definition, is delta 1. And then long call has positive delta. And then you look at the 70. If delta is 70, 0.70, then if dollar moves a dollar, if the stock moves by $1, then your option is going to move by 70 cents. And that can help you determine your stop levels, target gains, how much profit you're looking for. I usually would just remember one, and then you can derive, okay, short call is negative delta, long puts, negative delta, it's the opposite of long calls, and then short puts have positive delta. For the average retail investor, I would say the most important is hedging, right? You can look at the delta to determine how many contracts you need to buy to offset, right, the pullback in your stock. And it also is a great way to use as a hedge, right? So, to determine probability, right? To determine probability of success, right? So here's an example of $1 move in XYZ stock trading at 105. It's a May contract, 105 trading at $1.25. At the money delta around 50. And if stock moves by $1, then you can you can approximate what the option is by just adding $1.25 plus 48 cents. And again, going back to statistics, I use options primarily for estimating the probability, the probability that the stock will expire at that level, right? And this will be a profitable trade by the expiration day. Any questions on Delta? Keith, anything to add on Delta?
Yeah, I mean, I think that you covered it pretty well there. I think the one thing that, just to expand upon, the delta is a good proxy for that probability that the option will finish in the money. So when you're looking at an option, you see it as like a 30 delta. That means that there's a 30% chance it finishes in the money, assuming that normal distribution. So even if it looks like it could be a very leveraged trade, you have to keep in mind that the odds of success are lower when you've got an out of the money option, and thus the delta is lower.
Okay. And then again, as an example, we started going over last time. So this is the AGT website, and they do have Winston, right? So you can basically ask questions. Can you explain? Or if I am bullish on Google, right? Let's say Google announced earnings today. What delta should I use? Should I use for my long call? Suggest strike price, delta, and time to expiration. All right, so this is a AI agent that's optimized on the financial data and broker dealer, the trading options, trading stocks, and can answer most of your questions and can help you make that decision in terms of what strike price is selected, what time to expiration selected, or if you don't understand what delta is, then it will crunch the numbers and then go back and tell you what expiration strike price to select, right? So you can say, October 30th, underlying price 285. When bullish on Alphabet, option traders typically select a call with delta between 0.7 and 0.60, right? That's a very common question that I get asked, what should I use the delta? And then near the money or slightly in the money is preferred for directional trades, right? 0.7 is optimal if you're bullish, right? But you're not sure about the velocity. We're going to talk about, gamma, right? The acceleration. If you think there is going to be a large gamma and the stock is going to move rapidly fast to the right, then you can do out of the money, but then you're sacrificing on probability, right? Because you have to be correct not only in direction, but also on how quickly the stock is moved, right? Going back to physics and calculus, velocity versus acceleration, right? And then times to expiration. Similar idea. Usually you say 45 days till expiration. But especially if you're new, this is a great way to kind of figure out, what the trade, it suggests your underlying price, right? It suggests your strike price selection, what the delta should be, and, the trade setup, right? So this is a great way to kind of quickly find the optimal strategy or optimal strike price selection or expiration months. All right, so that's delta. Now the next one is also important is theta, right? So theta is the change of option value given 1 day change in time, right? Delta was, okay, how much do I move how much does the option move for $1 move in stock? Theta is, well, what's the time premium, right? The first concept is in options, there's always, unless it's very deep in the money options, there is always extrinsic and intrinsic value, right? We're going to go over this. So theta basically affects your extrinsic value of the options. I always think about it as the ice cube, right? How quickly is that ice cube melts, right? And at some point, if you go back to your chemistry class or physics class, you see kind of a curve that, in terms of how theta changes with the sensitivity to time, right? So all options lose values, they get closer to expiration, right? And that's where that acceleration, right? It's not a linear relationship, right? It exponentially increases as you get closer to expiration. Options tend to, and that's why for regular investor, usually the idea was, when do I close my trade? And we always say, well, close the trade at least, some people say 5, some people send 10 days to expiration. Okay, well, maybe we should ask that as I speak. Okay, based on Theta, when should I, how many days? How many days till expiration? How many days? How many days before? How many days before expiration should I close my long call position? A very popular question. And again, apologize for spelling and some of the Russian accent, but I think it usually understands what I mean. So let's see what it says. Right? But usually it's 10 days till expiration. I actually didn't run this scenario. You want to make supply and minimize losses from time decay, theta, and the alphabetic long call. Timing is everything. Timing is everything. Current 10:37 today's expiration out. Earnings October 29 just passed. Highs in the 1 to 2, 3 days before the expiration. Theta risk window, right? So the closer you get to the expiration, the option, especially at the money option, moves in tandem with the stock. And options give you leverage, right? When I buy one contract of Google, it's 100 shares. 100 shares at the, did it say the price of Google? What's the Google trading right now? Let's see. $285, right? So 100 shares of 285, that's $28,000, right? So it's a lot of exposure, and that's probably the most common mistake retail investors do. They don't realize sensitivity of theta to the expiration, and then when options get closer to expiration and they move as much as stock, well, 1% move on $28,000, that's $285, right? So time decay increased sharply in the final days before expiration, especially for short-term option traders. Why it matters, holding through the last 2 to 3 days can erode premium quickly, even if the stock moves in your favor, right? And then the question is, are you long or you short volatility, right? If I have long call, theta is against me. If I have short put and I'm selling, let's say, time decay on those Google puts, especially after the expiration, then you can see then theta works in your favor. So it's, depending if you're long or short. Volatility drops after earnings, crushing option value, right? So Google just announced earnings today, and drops after earnings, crushing the option value. What else is interesting? Optimal exit 1 to 2 days before expiration. I think that's aggressive. I would say on average retail investor, because of this reason, I would consider somewhere between 5 and 10 days before the expiration. Google's trading the build up to earnings and expiring the days before results. And if you have your stock position, right, and you have a Google, this is the perfect time to maybe sell calls, out of the money call spreads, right? Or if you don't think Google is gonna have bad earnings, then you can sell put spread. It doesn't always work. You see Meta was down 10% today. So you have to be careful when you sell premium. But if you do want to sell premium on Google or Apple going into the earnings event today, this is if you're bullish on Apple and you think, everybody needs a new iPhone and their numbers are actually better than expected, then this is the time to sell put spreads on the Apple if you have the bullish view, and vice versa. If you have a stock and you're concerned and you don't think they're going to hit a home run like Google, then you sell out of the money call spread. And I think actually Google lost most of its not most of it, but half of its gains since the earning announcement. Final 30 days, the point price accelerate. So usually represents a negative number. It means there is a decay, you're long, right? Doesn't change out of the monetary option with state of 0. So you can say every day negative 0.5. Today it's $3.50. Tomorrow it's $3.45. And the concept here, the most important that people don't realize, I think, average, is that if the stock doesn't move or trades in a range, then every day there is a decay, right? There is a decay in the premium of that options. If it's a longer dated options and there's plenty of time to expiration, you don't have theta is small. But as you approach close to expiration, that theta starts accelerating. And export, this is an example of looking at the specific strike price and figuring out how much what is the extrinsic value and what is subject to the time decay, right? So I think I did spiders here, 677, so same thing. You can go back here, pull up your chain, type in spiders, right? We're not going to do risky trading. We're going to go to monthly expiration. And you can look, if you want to see what monthly expiration you want to select, usually most of the gamma, most of the open interest, the highest open interest resides in monthly expiration, right? And you can look at November expiration at the money options, right? 680. You can look at the open interest, right? 26,000, right? Right now it's 680, 26,000, probably the largest number. And surprisingly, which is unusual, December has higher open interest, right? Higher open interest, meaning that people are hedging end of the year, right? So maybe instead of buying November contracts, maybe you would buy December contracts based on the open interest, right? At the money options. But if you want to know what the 680 call is, right? Let's say I'm bullish on spiders, right? I think we just reduced the tariffs on China. We have, we're friends with China again, and government shutdown is hopefully going to come to a resolution, and 85% of the companies beat earnings estimates. And less regulation. So if you're bullish on the market, let's say, okay, I'm bullish on the market. I think spiders will be at 700 by end of the year, right? Then if you want to buy 680 call at the money call, right, you can how much is extrinsic value, right? So then stock is trading 683, right? So you have $3 of intrinsic value, right? And the rest of the value based on the bid ask is extrinsic, right? So if it's trading at 19, $3 extrinsic, 16 is subject to time decay, right? And then you figure out what the theta is. You can ask, let's see, Winston, right? And ask for the, I don't know if it can. Let's try. Can you approximate theta for a December 680 call on SPY? And then I would validate the data, right? Because the AI usually do not have access to real-time data. So this is something that you always want to kind of disclaimer, validate to make sure that this is right. But in general, it can help you, or you can ask a question. What is the optimal theta to select? What strike price to select to sell premium, right? Less than zero. Most of the options is extrinsic value time provided with such distance. Okay, so it can suggest you, right, at the money call what the approximate theta is in the money, right? And out of the money, right? Out of the money, less sensitive, right? Closer to the money are more sensitive. All right, so that's theta. What part of the option is subject to time decay? We went over that example. And why is theta important? The only way to have a positive theta position is to be overall short options, right? So going back to delta, if you look at your overall portfolio and it's negative, that means you have more short positions than long, right? Potentially, and that will be a sensitive time decay. Assuming you can be long put or short call, but if you have more if you have more short positions, then overall your portfolio will benefit from time decay. If most of your positions are long, then overall theta will be against you. So short straddles, strangles, any credit transactions that you sell for credit are subject to time decay. Any questions on before we jump into gamma, theta? Keith, anything to add on theta from your perspective?
No, I think you've covered it pretty well. I mean, if we're sticking with that velocity and acceleration perspective, I guess theta is the cost of idling, right? It's just sitting there, and you do burn gas while you're sitting stagnant. And the longer you sit, the less likely you are to go a long distance in a short amount of time. So, you know, when you have more time, you could have a greater possibility of getting that distance achieved. But over time, you know, the goal isn't going to be met. If we're trading where we're at right now in SPY, it's a lot less likely that we're going to get to 700 today than 700 in 2 months. And you have to go very fast to do it. So.
Very good. Thank you. Any other questions on Theta? Let me know if you guys have any questions. Let me just check. Okay.
So far, so good, Vlad.
So far, so good. Okay. Gamma and, you know, now we're going into second derivatives. So if calculus was not your favorite class or second derivative was hard to understand, you know, my opinion, at least before a couple of years ago, like most retail investors don't need to know about the gamma. But I'm going to go over the gamma anyway, because I think if you've been in my webinar, I talk about gamma exposure, right? Positioning, right? Gamma turning from negative to positive. I think this is extremely important concept, right? It's an extremely important concept that you would need to understand, right? And even if you're a stock trader, you don't actually, you know, make markets, or you're not a proprietary hedge fund that, you know, trying to be gamma neutral, right? But it's important to understand that concept, right? So on high level, again, velocity versus acceleration. It's a second derivative, right? It's how quickly velocity changes when you drive your car with constant velocity, right? And you're driving 60 miles an hour, right? And you're just driving 60 miles an hour, your acceleration is 0, right? But if you rapidly go from 60 to 80 in a very short period of time, then your acceleration increases, right? And that going back to the concept of gamma. It's acceleration of delta, of price change, right? The higher the gamma, will have a higher risk and potential reward. You see these gamma squeezes, right? When you can, like, we've seen it in silver, right? We've seen it in silver. We've seen it in gold. We've seen it in some of the semiconductor stocks, in the high beta stocks. Usually high beta stocks, you have this rapid acceleration to the upside, right? You have escalated up and then elevated down, right? Usually it's because of the gamma, right? How quickly the price changes, right? And when there's no more buyers and dealers have to become gamma neutral, right? That they would sell stock. So understanding the gamma is important, right? This increase in gamma will increase value of option, right? And most popular is that, back to meme days when somebody says buy GameStop and everybody's starting buying calls. That's a perfect example of gamma, right? If you look at the chart, you have the vertical move to the upside. All right, let's see if we can ask our show recent chart of IO and Q. All right, so quantum computing, AI, right? The models have to run fast. They have to learn. They have to make an inference. So we're in a war of speed, right, and scale, right? So quantum computing can show you kind of basically where you can see these vertical moves to the upside, right? Usually they are supported by large call buying, right? And on the other side, somebody's selling you these calls, right? It's the dealers, and dealers have to hedge their portfolio, right? So you have the vertical moves to the upside, and then sharp move to the downside because of the gamma squeeze, right? And show recent chart of silver. All right, so same thing. Everybody's piling to silver. Silver hasn't done much, and since April, I don't know if I can see the April here, but you can see it went from, I think, 20 to 50, right? Similar to 2011. It's a once in a decade or multiple decades opportunity, and everybody piling into the trade. So everybody buying calls until you have a gamma squeeze, right? And then, so understanding why this happens, because a lot of people even on the news say, why is silver down? And people think about, okay, Russia, Ukraine, war, geopolitical risk, tariffs. No, I mean, there's mechanics of these events can trigger, right, the acceleration or deceleration, but the mechanics is that there is a buyers and sellers, right? And somebody's buying calls, somebody's selling calls. Buying calls, people think the price is going to continue going higher, but once there's no more buyers left, well, dealers have to become neutral, right? There's a time decay, so they start selling the stock position. So that's gamma. And then sensitivity of gamma, right? So the closer to expiration you are, the faster option price will move as stock prices change. Don't wait till expiration. So whether it's a gamma or theta, you can see that further out 9 months options are less sensitive than 3 months options, or less sensitive than 5 the options. And if you wanted to break it down, we can say, can you help me visualize sensitivity of gamma to time to expiration. See if it ends. Actually, copy these questions because sometimes you have to be careful of how you word it. You can fool the AI agent, but for the most part, it gets it right. Gamma measures how much an option delta changes as the underlying price movement. As expiration approaches, gamma increases sharply, especially for the at-the-money options, right? And this means your position becomes much more sensitive to price changes in the final days. Below is visualization showing how gamma ramps up as time to expiration, right? So further out, small. As you get closer, extreme movement, right? And the further you go, or if you compare, if you want to select, okay, do I do leaps 9 months to expiration, or do I do regular options, December option, then this will explain you how the gamma will change, right, prior to expiration. Right? You can see, the closer you get, and this is showing you at the money options or out of the money options, right? Delta and gamma for each strikes markedly different, right? Three actually happen near the at the money strike. As you can see, the gamma increases dramatically as the difference between the strikes delta becomes more pronounced, right? So you can see, on these options that the difference between at the money options, right? That they're a lot more, gamma is a lot more sensitive. All right. Any questions on the gamma? Let me see if there's any questions. Gamma. And then, so in terms of gamma, the other thing, you can say, please explain, when gamma squeeze. If I probably misspelled it, but rapid outsized move in stock price often catching both traders and investors off guard. What is the gamma skills? In option trading, gamma measures how much an option delta changes as underlying stock price. We went over that. When many traders buy short-dated call options, especially out of the money or at the money, market makers who sell these calls must hedge their risk by buying the underlying stock. And as the stock price rises, the delta of these options increases, forcing market makers to buy even more shares to stay hedged. And the feedback loop can drive the stock price sharply higher, right? Heavy call buying. So, you can, look at these key takeaways. Also, gamma, what is gamma? Flip point, and can you approximate gamma flip point for SPY if SPY is trading at, what is SPY trading at? 684. So that's another very important concept, that even if you don't trade options, you don't really care about second derivatives, will be a better explanation than watching Bloomberg News why silver, sold off 10% in one day, right? Is where options market makers switch from being net long gamma, hedging by buying the underlying price, to net short gamma, right? So you can look at the gamma, different strikes, different expiration. When dealers are net long versus short, that is the critical point because it marks a change in hedging behavior, often increasing volatility and directional risk in underlying price. Right, so current price 684 near a large open interest strikes. So usually where you look at the open interest and where there is the highest open interest, that's where it could be used as a either magnet or a repellent. So with spiders trading 64, the gamma flip point is typically very close to the current price, right? I mean, I usually look at SPX, so you can, 680, 675 is where you find that gamma flip point. Largest close in the gamma flip point would be 685. So you look at the largest gamma flip point, but the idea is that dealers are generally long gamma below this level and short gamma. So that net flip point is where the sensitive, it's dynamic. Any questions on gamma? Keith, you wanna? What's your experience with gamma?
Oh,
How do you use it?
I could probably talk for hours on gamma, but I think that flip point is actually a really big thing for market makers, and that's crucial to understand. When you start having a position like a call vertical for a market maker, they may be selling stock into a rally to hedge long gamma, and then all of a sudden you keep going higher, and instead of selling, they're buying back stock to cover now new short gamma because of the long or they're short out of the money calls. And it definitely creates a dynamic where you kind of go slow and then all of a sudden you go fast because they're selling into a rally and then buying into a rally and covering back that position. And it can make for some wild experiences when you're really watching that stuff closely. So certainly something to watch as you're going through your stuff.
Perfect. Thank you. All right, and the final is Vega. Change in option theoretical value given 1% change in volatility in the underlying, right? This is what Keith used to do for a living, right? As a market maker, trying to approximate the prices. But I mean, I personally don't use Vega in any shape or form. But maybe Keith, do you have some words of wisdom on Vega and how retail users can use Vega?
So I think the biggest thing is if you don't have an opinion on Vega, then spreads become a much more relevant part of your trading. If you want to have a long outright option position, you're going to naturally have a Vega position. These options that are going into earnings in particular, it's very risky to either buy or sell options, not just because of the delta and the gamma and the theta, but also that Vega. I mean, I was just looking at it as we were talking. A good example might be Google, the stocks trading 285, the November $300 calls, even though we've rallied $10 today, are down on the day. So even though you think that because of Delta and because we got a 3.5% move, that Vega crush post earnings turns what seemed optically like it should be a winning trade. I'm long calls and Google went up. The Vega crush reduces that from not even just a break even, but now it's actually a significant loss on calls like that. So definitely be aware that every option has that embedded Vega risk. And actually, if you go into spreads, you can reduce that significantly.
Thank you. Yes, so very good point, right? If Google would continue going higher, then that option price would go up. But because you have that spike in volatility and then the drop in Google, right? That's probably the main reason why actually, even though overall Google is up, but the volatility is disappearing, right? And tomorrow and day after tomorrow, it's going to even disappear faster. And then same thing, front months options prices affected less by the change in underlying volatility, right? So we can ask, we can ask Winston also, but the idea is here is that, front months options affected less, right, by changing underlying volatility. But this is an example where if you had a Google that a leap, right, you had a 9 months leap, and though, you bought it yesterday, but today, even though the stock is up $3, you could be down on that option, right? Because you bought it yesterday when volatility was at the highest rank, and in a couple of days it's going to be the lowest. And even though stock is up, but your position is down, right? So it's important concept to understand, especially if you trade in leaps, right, versus front mounts options, and if you don't do verticals, right, if you don't do the spreads. So in terms of probability of success, I did create, in terms of some of the trade setups. Let me just copy it. So which stocks have highest exposure to rare earth metal, right? I kind of wanted to give other capabilities of Winston, since he can help you make some of these decisions. Rare earth metals, right? So there's a lot of stocks, I mean, different themes, right? Whether it's AI, right, theme, or rare earth metals is another one, semiconductors, so you can always figure out, that's a very common question that I get asked, what is the, what rare earth metal should I trade, right? And, usually I would just go to Winston and ask, I think I got tired of my questions, but it will tell you, give you suggestions of, if you're long on the sector, okay, so MP, right? So MP is, a stock you can consider if you want to have exposure to rare earth metal and you think China-US relationship is going to be affected, but it's not a done deal. Yeah, MP is down today with anticipation that there is going to be amicable solution, which we have. But if there is an escalation, if you think this is overdone and there'll be an escalation somewhere down the road, then okay, then this is something you can ask. What else? So you could say, what is the best option strategy for MP if my time horizon is December? Right? You can do it for any stocks you want. So just walking you through the process of how you can make these, ideas that can help you actually select the, some of the concepts that we talked about, right? Long leaps, capture upside if you expect significant appreciation, higher premium, right? Unlimited upside, risk of decay, time decay, versus call spreads, right? Call vertical, right? We talked about that. Reducing cost risk by selling a higher strike call against your long call, limit maximum but lower. So it gives you different strategies and different, setups, right? So if you want to do a vertical call, here's a suggestion. You can buy 65 call on MP and sell 75 call. So the structure lowers your net premium and defends, right? So key takeaway, if you're bullish, so you can do a spread. And just remember, this is not an advice. This is just to help you structure your trade if you have certain idea about a stock. Then you can go here, like what are the main risks that could prevent MP from reaching the year end? I think this is a good question. Right? Very common question. So then it can go through fundamental analysis, geopolitical risk, and actually tell you, what some of the things that you want to, consider if you are buying, let's say, leaps or versus shorter dated options, because the longer you wait, then the more likely you're going to have some of the other events. And so China export controls, right? So it can get the AI can do the research for you and tell you exactly which of the geopolitical risk or cash flow risk, right? Can, if there is a heavy debt in that stock, it can also warn you about that. So this is a great, insights that you can get. And you can see, can you apply Monte Carlo simulation? Will work next release. That's not going to work exactly, but you can basically run simulation analysis. And it will tell you the range that MP can be trading by the end of the year and gives you, possible outcomes, right? So that would be another question. And, there are a few other questions that you can talk about: profit and loss charts, support and resistance, etc., etc. All right. Any questions?
Yeah, thank you so much, Vlad and Keith. That was a ton of information in kind of a short amount of time. Even though we went a little bit over, there was just a lot to share. So I didn't want to cut anybody off. Thank you for doing all that. And I think we got a lot of good comments, a lot of good focus on the Greeks. And thank you for demonstrating how Winston can be such great help on the Avant-Garde platform for just understanding, you know, basic info about the Greeks and how people can ask specific questions and get more information so that they can make their ultimate trading decision. That was great. As I said, I know that was a lot of info and people tend to have questions after the fact. So everyone please take note of the email on the screen. You can reach out directly for any follow-up questions regarding this specific webinar. If you have questions regarding Avant-Garde, you know, our platform and the associated Winston bot, please feel free to reach out to us over here at Avant-Garde. That would be info@tradeagt.com. I'm going to go ahead and take the screen deck as we wrap up here today. Again, thank you everyone for taking the time. Just a reminder to everybody, if you don't already have an account with us over here at Avant-Garde, I encourage you to head to our site, tradeagt.com. We are offering commissions membership pricing for free through the end of the year. So take advantage of that. Again, tradeagt.com, it's here on your screen. And as a reminder, please sign up for all of our upcoming webinars. We'll definitely be having another lunchtime options trading webinar with Vlad and hopefully Keith if he's available. So keep an eye out on your inboxes for the replay from info@tradeagt.com. And we will see you at the next webinar. Until then, thank you to all and good trading for everyone.
Thank you so much.
Thanks, Vlad. Thanks, Keith.